Well, thanks a lot to the organizers for putting together this excellent conference and for including our paper on the program. My name is Shen, and I'm from the Federal Reserve Bank of Boston, and this is joint work with Veronica Niepmann from the Federal Reserve Board. Everything I say today are our views, not that of the Federal Reserve System. All right, so geopolitical risk has become top of mind for policymakers, market participants, and that's evident if you read meeting minutes from key policy meetings, whether it's the ECB monetary policy meeting or the FOMC, and also if you look into speeches and board meetings by key firms in the economy, such as a quote here from Jamie Dimon from JP Morgan. It's evidence that geopolitical risk is something that people are very worried about. And indeed, there are reasons to think why geopolitical risk may be distinct, because it often involves catastrophic scenarios: expropriation, breakdown of legal order, and extreme uncertainty. Yet, the financial international mechanism through which geopolitical risks are transmitted is still to be understood. As you can also already infer from the title of this paper, the focus of this work is on banks. We want to understand the relationship between geopolitical risk and banks. And especially global banks, they're inherently exposed to geopolitical risk given their global jurisdiction. And with the outbreak of the Ukraine war, there were a lot of reports that came around that time wondering about the extreme uncertainty of Western banks that had exposure to Russia and the outcomes and how they're responding to that. And understanding this question is particularly important given the long established literature about the importance of credit supply decisions by banks for the real economy. So for this paper, we're going to focus on two questions. First, how do banks respond to geopolitical risk? Is this response distinct from other macro risks that we have studied? Second, what is the implication for domestic credit supply? So essentially, is there spillover effects? So the focus of this analysis is on US banks. And we're going to conduct analysis into three components. The first component, we're going to construct measures of bank-specific geopolitical risk indices using both established and newly constructed country-specific geopolitical risk index. And the second is the empirical component of our paper. And we're going to ask, how does geopolitical risk shape US banks' foreign operations, and whether the increase in geopolitical risk abroad affect domestic lending. And for this component of analysis, we're going to use several supervisory data that the Federal Reserve have access to. And that includes the FRY14Q that many of you may have heard of. That is data at the loan level, and it has information about the riskiness of the loan, the origination amount, and we have information about who are the borrowers and the country of the borrowers. The second data set we're going to use is what's called FFIEC 009. That is a country report of exposures by US banks across the world. So this data is at the bank country time level, and we have information about the exposures of the different US banks. And in particular, we have information about the mode of operation. So we can see, for example, hypothetically, Citibank, how much it is exposed to, say, Russia directly from Citibank US versus Citibank that's operating in Russia, so the affiliates. The former of which we call cross-border claims, the latter is called local claims. And we also have done some work using the SLOOS data, and this is the confidential version of the SLOOS that's at the bank level about bank lending standards. I'm not going to have time to get into detail about that, but this is another margin of domestic spillover that we look at. So with empirical analysis, we're going to then introduce a simple model that helps us to explain the results that we're going to show and help to clarify the mechanisms. All right, so here is a preview of the main findings. On the empirical front, we established 3 main findings. The first is that an increase in geopolitical risk increases the credit risk of the exposed banks. Second, US banks, they do reduce cross-border lending to the countries that's experiencing increased geopolitical risk, but their lending through their affiliates in these countries continues despite the rising credit risk that we find in the first step. And moreover, we find that banks do not adjust their foreign exposure similarly in this asymmetric way in response to other macro risks. And third, on the spillover effects, we find that in response to higher geopolitical risk, banks reduce C&I lending to US firms, and they also tighten lending standards in terms of domestic loans. And this effect mostly stem from geopolitical risk in countries where banks have these local operations. And in terms of model, we're going to show that these results can be explained by 2 key factors. One is the differences in funding structure between a local operation versus a cross operation, combined with some of the unique nature that comes with geopolitical risk, which you can think of as destruction in asset valuation that could come from, say, expropriation risk, physical destruction, profit repatriation frictions. And the key idea there is that foreign funding, which foreign affiliates receive, can limit the downside losses for the bank. So I'm going to go into detail about each of the components of analysis. So first, let me give an overview about how exposed are US banks to foreign economies. So the left chart here shows foreign exposure as a share of total assets of US banks. So about 20% of US banks' assets are foreign assets. These are the most internationally active banks that you probably are thinking about in your head. And the right side shows local exposures. So how much of that exposure come from the branches subsidiaries that these banks have in these foreign countries as a share of total exposures. And around half of banks' foreign exposures stem from assets in foreign branches and subsidiaries. And this is a more granular view where we take 4 active international banks, US banks, and look at the countries they are most exposed to over time. So 2010 on the left chart, 2019 on the right chart. And the key takeaway here is there's tons of heterogeneity in terms of how banks differ in terms of geography and magnitude of exposures across different countries, and this heterogeneity also changes over time. And with that in mind, we're going to construct a bank-specific geopolitical risk index, BGPR. And this BGPR at level of bank B time T is a weighted sum of the country-specific geopolitical risk index, CGPR. Okay? And the weight is using the exposure of a given bank to a given country by the overall assets of the bank. That includes the domestic assets. Okay? And we have various constructions. So the main baseline one is 4-quarter weighted average. We also use other variants for robustness. Now, the key question here is, what do we use for country-specific geopolitical risk index? So we use 2 sets of measures. One we view as kind of a more established one, as some of you may be familiar with, the one by Dario Cadara and Matteo Iacovello. And they construct a newspaper text-based method to construct this country-specific geopolitical risk index using the dictionary words that captures geopolitical risk. And so whenever you see a subscript N, that's a newspaper-based measure. And then we're going to supplement that with something that we construct, use firms' earnings call transcripts. So we're going to use the same dictionary as Cadara and Iacovello, and we're going to use the methods a la Hassan et al. To which the measure captures firms' perception of geopolitical risk, and we aggregate that up to the country level. And we mainly view as additional set of robustness to the main measures that we have. And it also allows us to kind of get deeper into different dimensions. Since we're aggregating from the firm, we can see which type of firm, as well as divide that into some words related to threats, some related to acts. So let's now look at these measures at the global level. So the left side are the geopolitical risk indices. The top one is the newspaper one, and the bottom is the one we construct. And at the global level, you can see the spikes are driven by major wars: Iraq War, Russian-Ukraine War, and the Israel-Hamas War. And on the right, we compare that with some of the more established risk measure that's known. The top right is the one by Hassan et al. Using the earnings call methodologies that we use for our measure, but just looking at economic uncertainty in general. And what's picked up there in terms of spike is global financial crisis, debt crisis, COVID. And the bottom right is the World Uncertainty Index by Nick Bloom and co-authors. And there also you can see what's driving some of the spikes are debt crisis, US fiscal cliff, and COVID. And we can also look at this at the country level. So this is just an example looking at Poland. The left panel are the geopolitical risk indices, and we see that the spike really came after Russian invasion of Ukraine. And the right are the various economic indices, including now the CDS spread on the bottom right. And there the spike is also the global financial crisis, European sovereign debt crisis. So from there you already see some distinct factors related to geopolitical risk relative to some of the other risks that we've been studying. So now with that, let's look into the empirical results. The first set of results is going to concern whether banks are accounting for geopolitical risk on their balance sheet. So we measure credit risk based on the weighted probability default of these loans from the credit registry, the Y14 data. And we conduct this analysis both at the bank country level as well as at the bank level to see if the size is enough to even show up at a more aggregate level. And what we find is that banks, they indeed take that into account. They assign a significantly higher probability default to existing loans to countries that's experiencing an increase in geopolitical risk. And that effect is substantial enough to show up even at the bank level. And we also look at an event study focusing on pooled two events, looking at Russia's annexation of Crimea in 2013, as well as the invasion of Ukraine in 2022. And we see a huge spike in the credit risk that's assigned to loans that's exposed to Russia relative to all other loans on these banks' balance sheet after the shock. So the first takeaway from this set of results is that geopolitical risk increases US banks' credit risk. Now, how do banks respond given this increase in credit risk? Now we're looking at how their foreign exposures are affected by the geopolitical risk as measured by the country-specific geopolitical risk measure. And in particular, we divide this foreign exposure into the cross-border component and the local claims component. So the red results shows on the cross-border front, we indeed see that banks divest their exposures to countries that's increasing geopolitical risk. But surprisingly, on the local claims front, we do not see a significant response. And these set of results control for bank country fixed effects, as well as bank time fixed effects, as well as some macro controls that includes the stock prices, the exchange rate, and indicator for whether there is a sanction imposed on the country. And now, do banks respond in this asymmetric way to other shocks, to other economic risks that we have traditionally been studying? So now we're kind of running the same regression, but with the other risk indices I showed earlier on the right-hand side. And we do not see this asymmetric response. So that suggests that there is something distinct about geopolitical risk here. So the finding two here is that banks continue to hold local claims in response to increase in geopolitical risk, while they do divest on the cross-border front, despite the increase in credit risk, unlike their response to other economic shocks. And third, we want to understand the implication for domestic spillovers. And for this, we're using the loan level Y14Q data at the loan origination, with loan origination as the right-hand side variable. And we use the bank-specific geopolitical risk index that we construct on the right-hand side. So we control for various bank characteristics, loan controls, as well as firm time fixed effects. So this is looking at firms that is borrowing from multiple banks, controlling for potential demand responses by firms to geopolitical risk. And we're restricting our sample to just US firms. So this is really isolating kind of the domestic component, trying to understand whether there is spillover effects. So I'm going to show results at the loan level. We also have conducted at the bank level, and the results all hold. So this is the baseline table for the spillover effects, where we look at the loan origination on the bank-specific geopolitical risk indices. And we see a strong negative relationship. So an increase in bank-specific geopolitical risk as measured by our BGPR measure reduces the loan origination by these banks to US domestic firms. And the results are very consistent whether we add additional macro risks as our control variables, and also whether we use the newspaper-based measure or the earnings call-based measure. Then we proceed to ask, given the evidence that we showed about the asymmetric response of banks in terms of cross-border versus local to geopolitical risk, whether the risk is stemming from local claim exposures of these banks. So to that end, we decompose our bank-specific geopolitical risk measure into the exposure that's just coming from the local component versus the component that's coming from the cross-border element. So the first two columns, the result is purely looking at the BGPR stemming from the local exposures, and we see a strong negative relationship. Well, in column 3 and 4, we look just at the cross-border component, and we do not see a strong effect. And column 5 and 6, we combine both, and we see that even with that, the effect of BGPR on loan origination is significant when stemming from countries where banks have affiliates. So with these results, the third results that we establish is when geopolitical risk rises abroad, US global banks curtail domestic lending, particularly when they operate affiliates in these affected countries. And we have additional set of results looking at bank lending standards that's consistent with what I have shown on the loan origination front in terms of spillovers. So then we want to move to how do we think about the mechanism that's driving these results? So we construct a simple model, but we think that's helpful for illustrate and clarifying some of the key mechanisms that may be driving these results. So it's a 3-period model with one bank, and bank is endowed with equity, subject to a leverage constraint that's Basel III style, so perfectly mapping what the regulation exactly accounts for when they think about these leverage constraints for global banks. Banks decide how they want to allocate funds between domestic and foreign lending. So they could do domestic lending, which is 1 period, risk-free and variable, or they could do foreign lending. It's 2 period, uncertain, fixed in amount. And they could do this through 2 modes. It could be cross-border, in which case it will be funded by domestic deposits. So it will be US deposits that will be funding these type of lending. or it could be through foreign local affiliates. Again, some fixed cost, but that part, it will be funded partially by foreign deposits. So these deposits that they could collect from the countries that they operate in. Now, foreign investment could be exposed to geopolitical risk. If a geopolitical event were to occur, the investment would yield no return. And the motivation there is, we think about the loss of asset values that could result from an expropriation, asset seizures, or destruction. In which case, banks would not be obligated to repay the foreign depositors. So this is the most extreme case, but all the mechanism of the model would hold if we think of milder cases of such scenarios, as long as there's a sizable decline in return that could be come along with costly repatriation frictions, for example, that will prevent banks from repatriating profits home. So this is a picture of the basic idea of the model. In particular, I want to point out that in period 1 of the model, the banks learn about whether geopolitical risk is high or low. So good state or bad state. And they can make a decision about liquidation at that given point in time. Banks can liquidate their foreign investment, but subject to some cost. But if they were to liquidate, that will eliminate the risk of coming from geopolitical disruptions. So the continuation value of the local investment is higher than the cross-border investment because the liabilities will be defaulted in a bad or high geopolitical risk state. So as you can already see from here, the model predictions are aligned with the findings about geopolitical risk and foreign exposures. Banks are more likely to liquidate cross-border investment than local investment, and this gap becomes more pronounced as geopolitical risk increases. And there's an additional prediction here. Banks are less likely to liquidate local investment the more it is financed with local liabilities. And we test this prediction where we interact the country-specific geopolitical risk with local liabilities of these banks. So this is the same regression specification as the foreign exposure from the earlier slide. And as you can see, the interaction term on these country-specific geopolitical risk and local liabilities are positive and significant for the local claims and insignificant for the cross-border. So this shows that banks indeed, they're withdrawing less from markets that's funded more by local liabilities. Now, we further solve the model to understand the relationship to domestic lending. And overall, the leverage constraint from there, you can already see there is a higher risk weight assigned to foreign loans. So the banks need to readjust their balance sheet elsewhere. So that will lead to a decline in domestic lending. So the model prediction on that front is also consistent with what we showed before about domestic spillover effects. So banks exposed to heightened geopolitical risk through foreign operations would reduce their domestic lending more. And the spillover effects will be larger when banks operate through affiliates because kind of the liquidation is less likely in these scenarios. And there's also some predictions about the spillover effects are larger for banks with lower capital ratios and profits, for which we also test using our data where we interact the bank-specific geopolitical risk index with the capital positions and profitability of the banks, and we find results that's consistent with the model predictions. So on here, I want to say a few words about some of the mechanisms we're thinking about. We think that one of the kind of stark examples of geopolitical risk may be expropriation risk. And if we look back into history, geopolitical risk has heightened likelihood of expropriation. We have seen various cases starting going back to 1917 was the Bolshevik Revolution, through World War II, and more recently was Russia's invasion of Ukraine, where Western assets are seized under these scenarios. But of course, we don't have to go to this extreme state. Softer forms of state interventions can also lead to the same mechanisms. And we have done some work on this front where we've constructed an expropriation risk index at the country level, and we correlate that with our geopolitical risk index, and we see that the variation in these two indices are very much aligned, conditioning on country and time fixed effects. So let me conclude. Our papers established 3 findings on geopolitical risk and banks' foreign and domestic operations. We see that increase in geopolitical risk increases the credit risk, and banks respond by divesting from the cross-border front, but not as much from the local front, and that's unlike their response to other macro risks. And we see a significant spillover effects. And we think that foreign funding from these affiliates can partially offset the losses through a reduction in liabilities, so lowering kind of net losses, and that's maybe a key mechanism that's at play here. Thank you, and look forward to the discussion.
Thank you, Leslie. And the discussant is Veronica di Falco. Hey, Veronica.
Thank you. Good morning, everybody, and thanks so much for the organizer for inviting me to this great conference and discuss this very interesting paper. So let me start by quickly summarizing the research question and the main findings of the authors. So the research question is broadly, how do these banks respond to increase in geopolitical risk? And the context in which the authors are studying this question is the US banks that have foreign exposure during this time span of 1986 to 2022. And the main findings are very simply summarized as follows. When geopolitical risk increases, somehow not surprising, cross-border lending goes down. Interestingly, the lending that happens through foreign affiliates instead remains quite stable. And more importantly, I think the result I actually like the best is the one about the domestic spillover lending, which I think it's very cool and I think could be emphasized more in the paper, which is about the effect to the home economy, so the US, the economy and US borrowers. My overall assessment is that this is a very timely and nice executed paper. They have great data coming from supervisory, balance sheet data of banks, and contributes to this new growing interest in the intersection of geopolitical risk and macro-financial stability, but also more broadly to a very long-standing literature that has been studying what are the determinants of international capital flows. It is very important also for policy making, thinking about what kind of factors should we think about and observe when it comes to the international bank structure and the effects of the bank structure on potential spillovers. My comments are going to be mostly on this result that cross-border lending and local affiliates lending are different. And I'm going to talk a little bit about the identification of this, then about whether this is indeed some asymmetry that is specific to geopolitical risk. And then I'm going to conclude a bit with some thoughts about the paper, regulatory implications, and a bit the framing in the literature. So the first point I want to focus on is this test of whether the cross-border lending and the lending through affiliates are indeed different from a structural perspective. And one thing, of course, that comes to mind when you think about this research question is it is potentially an endogenous choice of the bank to choose whether to lend via cross-border or actually open up a subsidiary or a branch in a specific country. And so ideally, if you want to think about how is the lending changing given a geopolitical shock, you would like to kind of hold things, the bank and the borrower, and really compare how the cross-border lending and affiliate lending change, one compared to the other. Now, there is a concern that indeed there could be sorting, the traditional kind of banking sorting issue of the bank might be sorting with different borrowers in different countries, and in particular also the way in which they lend might be endogenous to the type of borrower, say the industry, or the risk of the borrower. Now, there is a data limitation, so there's a certain amount of things that the authors can do and cannot, of course, do, given the data. Ideally, you will need to have a cross-country credit registry that also allows you to look at what is the type of lending and how is it done. Is it cross-border, and is this affiliate lending? But so what are the authors doing? So they're doing a good job because they're already including a bunch of important fixed effects. So bank-by-country fixed effects allow you to sort of take care of whatever sorting that it's static over time. And they're also including banks-by-time fixed effects that are going to allow to sort of compare borrowers within the same bank. But when it comes to this comparison of is the cross-border lending and the affiliate lending different, most of the regressions are using kind of a split sample approach that is comparing the two effects in separate kind of regressions estimation. And I think in this particular setting, this can be a little bit concerning because there is only a subset of banks that are actually choosing to operate through local lending. And so if you look also in the tables at the number of observations, the banks that are using local lending are very few. And so I wonder whether there is actually composition effects here that is driving potentially the comparison for which you're comparing sort of different sets of banks and country sorting. And so there are very small things that you can do to sort of attenuate this risk, which is estimate a pool regression with an interaction term rather than sample split, or restrict the sample to bank-country pairs that have both the cross-border and the local lending channel. Also, I think the paper could benefit from having a bit more summary statistics that allow us to sort of think about how are the banks and country exposure different and whether there is any sorting. The second point I want to raise is whether this asymmetry that it's found is really specific to geopolitical risk. And in particular to this idea in the paper, what is the mechanism? The mechanism is potentially, because of geopolitical risk, there is going to be expropriation risk. And the expropriation risk mechanism is corroborated by evidence that the reduction in lending is lower if the bank is using local deposits. So there is local funding. But, I mean, there's a long-standing literature on this topic. So, one of the papers that I'm picking on is a Schnabel paper that also shows that there is some similar asymmetry when it comes to transmission of liquidity shocks between cross-border and affiliate lending. And so I wonder how much this is really a specific feature of the geopolitical risk or a broader feature of the financial architecture of banking. And what the authors do is that they use other risk indices that Leslie has showed you to look at whether this asymmetry stands also by testing for different macroeconomic and financial indices. And I think what the authors could do to sort of provide more information about this is give us more comparison information between the geopolitical risk index that they're using and the other macrofinancial risk indices, as well as kind of similarly to what I mentioned before, kind of hold the sample constant across these specifications, given that some of these risk indices might be available for certain countries in certain periods of time, but not for others. Lastly, kind of broader kind of picture points. As I said initially, I really like this point about the financial spillovers to the domestic economy, because this has broad implications for how we think about stress testing, what kind of factors should we look at, and macroprudential policy. And so one suggestion I have that I think would enhance the contribution of the paper is to quantify more the magnitudes of these spillover effects and also give us some examples of like major events that have produced major spillovers in the US economy and potentially minor events that instead had relatively lower impacts. Finally, I want to sort of bring the paper also a bit, the paper is very well set in the international banking literature framing, but I think the results are interesting and could be also be framed closely to the more international capital flow literature, and in particular, these old frameworks of push and pull frameworks and the global financial cycle, and thinking a little bit about, I mean, these are my thoughts, but in principle, you can think about geopolitical risk as a potential kind of push talk that it's changing the capital flows from the US economy to other emerging markets. And this asymmetric response across lending modes can sort of be potentially a structural kind of poolside component that can explain maybe the heterogeneity across international capital flows. Overall, my takeaway is that this is a very interesting paper and definitely a growing area of interest. I really like the point that we should pay attention to the international spillover effects of this. And I gave a few suggestions to sort of sharpen a bit the analysis and the contribution of the paper. But to conclude, a very important topic in the current global economy and geopolitical landscape. Thank you very much.
Thank you, Veronica. Leslie, would you like to take a few minutes to answer? Yeah.
Well, thanks a lot, Veronica, for the thoughtful discussion. I really like a lot of your points. So let me just respond to a few. Yes, indeed, for the regressions for cross-border and local, I really like your suggestion about pulling the regression together. In fact, we have done that. and we do find that there is much stronger response in terms of cross-border relative to local when we pull everything together and add an indicator for the specific mode type in our regressions. And I think showing both set of results helps with that. And what adds to our confidence about these set of results is if we looked into earnings call transcripts of these banks, and there are statements which we cite in our paper are illustrating how banks are really thinking about these decisions and how they're thinking about the segmentation in terms of kind of the cross-border component and local components. For example, you read some of these large global banks after the Russian-Ukraine invasion, and you can see, that they are really explicitly talking about how, a lot of the exposures through their local affiliates may be thought of as kind of an isolated component, and where there are downside losses are kind of sheltered by the deposits or funding they're getting from these fronts. So that adds to our confidence about how we're thinking about these results. And I love your suggestion about the quantification. We actually also, that's going to definitely be incorporated in the next iteration of the table. We also have done that, and that's a very nice suggestion. And one final point I want to clarify is in terms of the Schnabel paper that you point out. So for that paper, they're looking at, using Peruvian credit history data, looking at how US banks are lending to Peruvian banks versus US banks with operations in Peru differently in response to liquidity shocks. So the key thing they're highlighting is kind of following this idea of internal capital markets by Settarelli and Goldberg, and how there's more internal capital markets working through within the banking organization in response to these shocks. So that is something I think is a bit distinct from what we're doing. So we looked at the internal capital markets components, and we do not see a significant difference effect in response to geopolitical risk. So less connection between kind of the home and affiliate in response to the geopolitical risk scenario. But thanks for raising that.
Thank you. All right, so I'm going to start here and then.
Thank you. Carolina Villegas, Sadean ECB. Very interesting paper. I was wondering whether you have information on the borrower side in the target country, in the end country, because there is this older literature looking at FDI, banking in FDI, that would accompany like firms. And I was thinking that maybe you could use that to try to distinguish your like seizing channel. So whether it's like these subsidiaries, these affiliates like lending to multinationals that now like are going also into trouble because of the geopolitical risk. And if you could distinguish like on the borrower side, like what these affiliates are doing, I think that would be like a nice exercise. Thank you.
Take a second question. Yeah.
Cosette, ECB. Thank you very much. It's a very interesting paper. I have a somewhat technical points on the spillover effects. So banks that are more exposed to geopolitical risk could be providing specialized loans, for example, to support exports. I have in mind, for example, the Paravicini rapproportionable paper that goes in this direction. But then the effects could come from a differential demand for credit by firms that, for example, export to Russia. And in this case, then, so if the banks that are more exposed provide a specific type of loans, then the effects could actually come from a demand effect. And I have in mind technically a violation of the Kwajalein assumption that firms are indifferent across banks. Maybe you could look at specific loans and check whether there is an effect. And if there is time, I didn't get about the, so you pushed a lot the risk of expropriation, but I wonder whether part of the increase in the risk of borrowers' default comes from the effects that were shown by the previous paper by Beata. So, for example, there could be an impact of sanctions, of secondary sanctions, and also reputational risk.
It was technically 3 questions, so.
So I think the first 2 questions I think are related, and we would love to look at the demand side at a more granular level. As Veronica alluded to, we would need kind of a cross-country credit registry in order to get to that dimension of looking at who are the exact borrowers of the US affiliates in these countries. So in one data set where we used to look at cross-border versus local, unfortunately we only have at the more area level. At the Y14, we can see the borrowers, but we cannot distinguish whether it's a subsidiary branch versus a home country. So we're kind of, our hands a bit tied on these fronts. With that being said, I think, no, even with the demand side being front, I think the evidence that we dug into on the various disclosure reports, earnings call transcripts, analysis about how banks are talking about the segmentation of the market and how the local ones are kind of thought of and funded and operated differently relative to the home in response to kind of what they explicitly say, an unexpected turn of events in the Russia case, gave us some confidence there is kind of a supply effect margin happening at the same time.
Yeah.
Sorry, the second question, sorry, could you remind me?
Yeah, I was wondering whether the increased risk of borrowers' default may be coming also from the impact of sanctions and reputational risk, and that was actually the object of the previous paper.
So I think we control for sanctions in terms of the cross-country relationships in our specifications. And I think now the key aspect we want to emphasize is kind of the differences in funding structures across the cross-border and local components, whereas these funding structures are providing some differences in terms of sheltering effect. There could be expropriation risk, there could be other types of risks, disruption, destruction that could come with geopolitical risk that affects changes.
And we have 2 questions, Arisa and Beata. Oh, 3 questions, sorry.
Hi, Larissa Schäfer again from Frankfurt ECB. I very much like this paper. I've read it actually already before. And I have sort of 2 interrelated questions. So one is related sort of to the story, also what Veronica alluded to, I think, and also Enrico. I think it's very hard to pin down this expropriation channel because overall, I find the result sort of a positive result maybe for global banking, because typically in the literature you see when there's a shock, foreign banks actually take out their money and lend more domestically, and you find actually the opposite, that somehow they continue to lend in local markets, which could allude to the fact that they're actually following the exporters and continue sort of locally having the local knowledge to lend with the multinationals, which I know you cannot look at. But I was wondering maybe at least what you could look at is maybe pricing, that it pays off for them to continue to go through this local market, and they sort of risk of taking sort of cutting lending in US, so it must pay off for them to do that somehow, right? So because I mean cutting lending in US just because of some small countries, I mean you know probably which countries there are. is a big thing, right? So, I mean, that must change sort of the profitability of the banks a lot. So it must be profitable to stay there somehow. Thanks.
Beata?
What is geopolitical risk, right? You talk about expropriation, but then you have shown us a spike in the index for Poland. So essentially, what you have in mind is Poland being invaded by Russia and expropriation happening. But could you really distinguish it from the energy shock that took place in Europe as a result of the war and affected Poland directly as well as indirectly through its links to the German economy, which went into deep recession? And second, you gave us example of JP Morgan Chase and other US entities being expropriated in Russia, but Raiffeisen Bank has been profitably operating in Russia. So is geopolitical risk a bilateral variable?
And last but not least, Katerina.
I have a very important question. Is it thank you very much for the very interesting presentation. Now, in the recent years, we have learned a lot about how banks react to uncertainty, and I can think of a few very good papers about this. But you showed us that your results do not hold if you look at other type of uncertainty measures or risk measures. And going back to Beata's point, what is that makes the difference here? What is the channel such that makes banks react differently to, for instance, uncertainty shocks or risk shocks in these foreign countries, which also have the potential to increase credit risk for banks? So maybe if you can share some more insights on what are the channels that explain this difference. Thank you.
And in the negative time that we have, please do provide some answer.
I'll be very brief. So I think some of the points are very much related in terms of the ex post effect, and I think that will be interesting to look into. So there is kind of the ex ante thinking about how banks are responding, then the realization in the long run about how things evolve, which they may not fully anticipate from the ex ante perspective, but I think it will be interesting to look at. And I very much like that point. And on the about what is unique about geopolitical risk, so we think of it as, it encompasses some uncertainty risk. For example, some of our components of how we construct geopolitical risk is kind of the uncertainty factors that's come in with geopolitical, but there is also kind of the physical destruction component that could come. So it's kind of some broader uncertainty, but something that's very unique to geopolitical risk as well. And so some of kind of the cases or the examples that I was thinking about in terms of extreme uncertainty, expropriation risk, asset seizures, repatriation, limits to repatriating profits, are something that are more likely to come in like geopolitical risk disruptions relative to just kind of economic crisis. And that is kind of what motivates to write down our model. So there's something here that's more than kind of just general economic uncertainty, which banks likely is more equipped to manage given their risk management function that's already operating at these banks. And so in terms of Poland, we agree that there is not kind of a expropriation likelihood isn't very high for some of these countries, but there is maybe like second order effects happening to that front in terms of indirect exposures, given that they are some more Russian related operations in these countries, as well as kind of the softer forms of interventions that I mentioned about some kind of limits to asset repatriation that could happen, which we've seen in cases of past crises. But I'm happy to chat more about that.
Yeah, not sure about the Russian-related operations there. Okay, thank you very much for this great session, and I think we have a break.